So now it is time, 10 o'clock. Good. So we're going to start off, I haven't got a gavel, all right? Ding, here we go.
I went like that.
Virtual gavel. Item 1 then, apologies and changes in membership, if any.
So we've had apologies from Paul Brading and Ian Ward. Nick Stewart has told me he should be coming, so must be just running a few minutes late, but we are quorum.
Okay. I did actually contact Claire and ask her if there were any substitutions, but I didn't hear anything back. So I assume there were no substitutions nominated anyway.
Not that I've been aware
of. Okay. We've got Martin, just to acknowledge Martin's online.
Good morning, Chair.
Good, we can hear you. Thank you, Martin. That's good. And item 2 then on the agenda is the minutes of the last meeting. I'll turn to the members of the committee here. Were you here at the last meeting?
Yeah.
No. Vanessa was here at the last
I was
meeting.
here.
And I was. Phew, that's good. So I'll propose, so for those who were here at the last meeting, Vanessa's proposing them, I'm seconding them. All of those who were here and in favour of the minutes of the last meeting. 2, good, they're passed.
Trust you. Staying, please, Megan.
Declarations of interest then, people. Do we have any declarations of interest? Steve?
I'm not quite sure, but following the conversations and registers we just compiled, I am a current recipient of a local government pension and a member contributing to further local government pension. So I don't know if that's an interest I need to declare.
I think if we had to
Okay,
declare
anyway.
people who were members of the pension committee, we'd have a few people at each of the meeting.
I think that it's your role it's your role anyway, isn't it?
Yeah. By virtue of being that you have the role. So,
Always a dispensation, isn't it?
hello, Nick.
Good morning.
Add Nick. And if we could pass Nick the signing sheet.
It's here and it's already there.
Right.
Yeah, all right.
Item 4 then on the agenda is public questions. Do we have any public questions? We have a constant dearth of public questions at our meetings. Right. Item 5 then is the operational update, which is in the capable hands of Chris Ward.
Chair, for those of you that were at the pensions board, this will be largely a repeat of that. I've updated it slightly, obviously, just because a couple of weeks have elapsed since then. So this is an update broadly along the same format that we saw last time round, which I felt that you found was helpful. So I followed the same thing. Some of the information will just be a recap, and something will need to tell you how we've moved on in terms of the overall administration governance side of the pensions function. So yeah, so just to repeat, I'll take you through where we are with pensions administration, where we are with governance, and where we are generally with governance, and what's happened recently in terms of government engagement. Because if you recall, last time we met, Chris had attended one of the government roundtables. Kevin from the Access Unit had attended one of the government roundtables, and I was due to attend a roundtable the very next day. So I'll just bring you up to date on what I heard at that meeting. That's towards the end of the. So in terms of administration, you'll notice in any event within the papers, or certainly within the papers and Martin's report, and it went to pensions board a couple of weeks ago, I think it was now, that the KPIs have actually dropped since the last time I spoke, but they are at 89.2% overall. Most of those indicators where there's a fall is where we've got it's kind of small volume activity, so relatively small changes can make quite a big difference in terms of percentage. But obviously there's that's on the agenda in Martin's area anyway. as we do the kind of forward look, we spoke last time about the fact that we have got an arrangement where we are clearly focused on what the work coming through looks like, so what the pipeline of work looks like, and making sure that we haven't got any gaps, and taking the support from Hyman's where we need it. So, I mean, Matt's here anyway, but the pensions increase and P60 work is complete. I am aware that we have got some data outstanding from one of the employers that is hindering our performance indicators to an extent. But you can pick up on that later in the agenda. In terms of staff vacancies, similar position to last time round. Last time round, I think I reported to you that we'd obviously appointed the employer relationship data quality officer, and we'd also appointed the pensions officer. Those recruitments, I understand, are going very well. And that is starting to enable us to take back some of the work that previously we would put out to Hyman's. So we still do have 2 pension officer vacancies, and a new campaign is currently is to be launched. I've called this new roles, but and appreciating that Matt's in the room here, so. It is important that we update you on what's happening generally in terms of pay and re-evaluation of pay, so that you'll all remember from the Barnett-Waddingham report that there was a general comment about the pay levels of the administration function in particular. So as part of the response to that, the pensions administration manager role was put forward for re-evaluation. It's been re-evaluated, and it's been re-evaluated quite considerably upwards. So that's positive news. And the deputy pensions administration manager, which isn't a post that we have at the moment, that was a new post to support in his role to provide some resilience to pensions administration. That is still in the job evaluation process. But once complete, obviously, it will be then out for recruitment. Just to remind you, we've still obviously got the backstop of Hyman's support in place at 120 hours per month, but that's flexible in terms of how we use it, deliberately designed because we weren't entirely sure what would happen in terms of the recruitment side of the administration function, how quickly we would be able to recruit, or whether we'd be able to recruit at all. So we have a flexible arrangement with Hyman's where we can switch support with them either from administration or into training or into other technical areas. So if we do recruit, then we can switch support from Hyman's into other areas. So that gives us security, but it also gives us flexibility. And as I've mentioned, we are starting to take some of the work back from Hyman's now with the recruitments that have taken place. Stop me at any point, by the way, because I'm just conscious that I'm whizzing through.
I'd like to ask how much are we paying Hyman's for 120 hours a month?
I've sent something round this morning which explains that, you know, because I think you asked the question at the last committee meeting.
Yeah. Because I obviously haven't had time this morning.
No, that's I understand that. It's obviously it's not inexpensive. It's 29,000 a month. But as I said, it is flexible. But we do have it's set out in its context actually in the written response, so it gives you a more rounded flavour of the position. But broadly speaking, what the written response says is, at the same time that we have those additional costs, we also have vacancy savings. So it's not a total cost to the pension fund will not be an additional 29,000 a month, because it will be offset by our vacancy savings, which are in the main the 2 pensions officers that I mentioned earlier on and the strategic pensions manager. I think combined those 3 posts on a monthly basis save in the order of 13,000.
I was going to say, that's 30,000. If you took out 3 pension officers, even at 70 grand, still costing us £100,000. And I found that appalling.
Well, let me carry on for a second. So we've done the financial forecast for the year, and the financial forecast shows that in overall terms, we will spend less. It will cost us, the administration function will cost us less this year than it did last year. So there's a number of different things going on all at the same time. We have the vacancies, we have the additional costs, we would always and historically have some support from Hymans anyway in every year. So some of that we would have called upon in any event. But in overall terms, our administration and governance costs will be overall lower in 24-25 than they were in 23-24. And I've also set it in the context of the Barnett-Waddingham report, because this is where a lot of that emerged from. And even they say that these types of risks you cannot avoid. If you keep an in-house service and it's a relatively small function, inevitably at times you will have some vacancies and some turnover, and you will need a safety blanket. And this is what Barnett-Waddingham said we would require anyway. We'd have to have a call-off contract to meet those times.
Business continuity plan.
It is to an extent. It is exactly that. It's exactly business continuity. But where you've got relatively low levels of resilience, you need to have something in place to compensate for that. And this is the arrangements that you have. You have call-off arrangements to compensate in those times of need. Have a look at the written response, and if you've got any further queries, then please, pass them on. But I agree with you. These arrangements are not cheap, but they're a necessity to have them in place in case you need to call on them. And it's absolutely necessary to have them, particularly when you've got relatively low levels of overall resilience.
A lot of detail in the report. It's quite good.
Sorry?
It's quite a lot of detail in there.
Yeah, right.
It's only about a page and a half, I think, but it tries to keep it, quite pointed. Any other questions before I move on?
Yes, I just have one other question. Jo, obviously, I presume that Jo, what are her hours in the pension scheme? Because she's also Treasury.
She is.
At the moment, I'm contracted for 1 day a week for the pension fund. However, as at the moment, I'm required to do a bit more. I am doing more work for the pension fund, but so far we've not actually done anything about cross-charge, any additional costs across.
Now that worries me, because we nearly burnt Jo out by sheer overwork. I don't know if the rest of you remember. I mean, she was so overloaded. Barbara, you probably remember that. And it worries me. Why is Jo not being devoted to the whole of pensions, or even more days a week? Why is it only 1 day a week? I don't understand how the council works in this respect.
Probably we shouldn't be using names at this point.
Yeah, but generally speaking, let me talk in the generality.
Yeah.
So nominally, for the purposes of planning, we will have made some assumptions about how much of people's time are devoted to the pension scheme, the pension fund. The reality is not always the same as what you plan. So nominally, that area, 20% of an individual's time is nominally as attached to the pension fund. In reality, if it took 5 days a week, we would provide 5 days a week. And then in the background, what we would be doing is we would be saying, how do we backfill the other work that individual is now not able to undertake? So we operate flexibly. We have to operate flexibly, and we have to call on the other resources of the council to backfill the work that, in this instance, Joe might otherwise not be doing. So it's just the way that we manage resources. It's not delineated in terms of an individual comes in and spends every single Monday doing the pension work, and then for Tuesday, Wednesday, Thursday, Friday, they do something else. I mean, we don't operate like that. You can understand we have to be flexible in the way that we operate. So the individual might come in and they might say, right, I've got to work a day on Monday, I've got to work a day on Wednesday. They will actually do it, and then we will manage corporately the impact on the other council work. And we'll either do that by supplementing it from somewhere else, or we'll slow the other work down if necessary, or prioritize the other work to the extent that it doesn't get done. But we don't deprioritize work of the pension fund.
What,
So we're not looking
Yeah.
to burn people out. I would like to give you that assurance. And we are absolutely committed to individuals having a work-life balance.
yeah, I mean, I can't quite understand this concept of where trying to employ people for the pensions. We have somebody who works part-time with the pensions. I can't get round the fact, why don't we just employ somebody else in the treasury management? I can't understand this splitting of work.
Usually,
Because as you said, it's almost impossible at times because workloads come in, flows, highs and lows.
that's part of it actually, because we wouldn't be able to employ an individual full time in that particular role on pension fund work. They'd spend part of their time with nothing to do. And the pension fund will be paying for a whole person and getting, say, 40% of their capability. So the other 60% of their time, what do we do with it? Unless we just employ somebody for 2 days a week, and then we've kind of lost a bit of flexibility in terms of how they can respond to the workflows that come in. So it's more about where you don't need a quantum of individual and you only need parts of individuals for different times of the year, where we then kind of manage it within a pool of resources rather than a separately dedicated resource. Where it's absolutely clear that you can fully employ a full-time person or 2 full-time people or 3 full-time people on a particular activity, you would do that. So that's
Some of these things are a symptom of the size of our pension fund and the role that we play. But there is a lesson to be learned here that given the criticality of positions that we have, that when we know that somebody is departing who is in a critical position, we need to be in a position to respond to that very quickly. So we know a lot of this goes back to December and perhaps beyond then, certainly. And it's taking a long time to address these issues. We'll let you carry on, Chris.
I have moved on, but that hasn't. Right. Okay. So this is just a recap really, and it is to provide you with a degree of assurance that things are being managed. So we continue with our planning meetings. We continue with our regular meetings with Kevin from Access. We're in the throes of a review of the risk register. I mean, that's obviously key to your obligations in terms of managing the pensions risks. And a bit more about that actually on the next slide that's coming, or a subsequent slide. The pensions regulator tracker review, that's in progress, and that will come to you at your November committee meeting, but it'll obviously go to the board first. The pension fund accounts, they're on your agenda today, and very healthy they are too. And you know what the vacancies are, and these are just a repeat of what I said last time round, but it's just important to keep it on the radar. Moved. Right, okay. So we've covered the vacancies around the administration side, and now we're looking at the vacancy for the strategic pensions manager. So I think last time round, I mentioned to you that we'd been through the recruitment cycle once and we had a failed recruitment. And I think Councillor Churchman, you asked me at that last meeting, when is it you get into awarding, additional market supplements? So we're now in the throes of the second advertising campaign. That is due to close towards the end of this month. So I think closing date around on the 21st of July. We've got interviews scheduled for the week commencing the 5th of April. Obviously, we don't know what the candidate set looks like at this stage. I can tell you that I've had a number of inquiries for informal discussions, and I've had a couple of those. I've got another one later this afternoon. But the previous campaign, that was obviously it was a failure, and we only had 2 applicants for that, both unsuitable. But I think I mentioned that to you last time around. So if we move on, if I just spend a little bit of time on the issue of risk. So we've spoken to you about the fact that we're not, even though we're in this position where we've got a number of vacancies, we're still moving forward with those things that are of keen interest to you, particularly around risk and the risk register. I mentioned on the previous slide that we're doing a comprehensive review of the risk register itself, and that is to look at a number of things in particular. The risk appetite. So what is our overall risk appetite? Where does the risk sit? Because I think in the previous risk register, I think just about every single risk sat with a single individual, which wasn't quite right, and neither was it practical to manage. We are reviewing the risk scores. We know we've actually got a number of duplications in the risk register at the moment, where the theme, it's a similar theme or the same risk, but which is manifesting itself in lots of different areas. So we're looking to rationalise that as best we can. We're obviously going to have a keen focus on the risk mitigation, and like I've said, remove the duplication. The other thing that we will do as part of that exercise is we will say to you that whilst we've moved from one form of presentation of the risk register to another, we will show you those risks that we've taken out of the current risk register. So there's kind of complete transparency of the transition from current risk register to new risk register. And you'll see how, therefore, those risks that we may have, say, taken out, but we've reframed them, they will be in the new risk register. But instead of you seeing a risk register that is about that deep, it should be far more focused, far slimmer, and give you the ability to focus on those risks that really need your attention. So that's the aim of it. But even though we're doing the review, that doesn't mean that we're not still moving forward with the risk work. And of the 6 key risks that we've got around capacity, cybersecurity, governance in terms of compliance with the pension regulators code, risk management policy itself, ESG and responsible investment, all of those things you'll recognise have either gone to the pension board a couple of weeks ago, e.g. cybersecurity, or spoken about here, capacity, or on today's agenda, ESG, responsible investment, risk management policies on today's agenda. And the only other thing that is on that list there that is in terms of our key risks is around internal controls. And if we look back on all of the audit reviews that we've had, there are no significant weaknesses in terms of internal controls. However, we continue to have an audit program in any event that seeks to review and reinforce that as we go through. So there's no dilution of the internal control framework review. So carry on quickly. I think I have to click the button. I think that's why. Yeah. Apologies, I've still got Jeremy Hunt in the background. But the meetings did take place when Jeremy Hunt was in the background. So as you'll remember, and I committed to you last time round, that we still believe that we have to respond to this request for a productivity plan. I will circulate that round once it's done. In general, half of the response will probably be the same response that they get from every fund that's in the access group, because it relates to investment. It relates to improved investments.
Could I quickly ask, is this the one that has to be in by July the 19th?
Yeah, that's right.
Okay.
Yeah, July the 19th, that's right.
When will we get the draft of that, Chris?
It will be some point next week.
Okay.
Um,
We will need to have a quick look at it. So
yeah, sure.
turn around very quickly.
And as I said at the opening of the presentation, there's been the series of roundtables. Obviously, Kevin and Councillor Jarman discussed their attendance at those roundtables. The one that I attended, I found it a bit odd, and I said this at the pensions board as well. It seems to be that each one of the roundtable meetings had a separate title. You know, it was focused in a particular area, but it sounds to me as though they covered exactly the same ground in every single meeting. So I'm not sure why they had different titles. But the key things coming out of it really were, and this was Simon Hoare, obviously previous minister. So we have a new government now. But what he did say, he said, and I quote, "There isn't a Rizla paper." For those of you that have smoked, know what the
Sorry,
roll
could you
ups.
say that again? There isn't.
A Rizla paper, you know, the roll ups.
Very thin paper.
That paper. So he said there isn't a Rizla paper between the views of the then government and Labour and the Liberal Democrats. He said he wasn't a tribalist politician, and he used to work cross-party. I think the messages that he gave coming out of that were, apart from that, he said, as far as they're concerned, still the primary focus is fiduciary duty, which is good, because that's our primary focus as well. He did say that they were looking for fewer, bigger and more locally focused funds. And he made reference to, and this has been in consultations before as well, so you will have heard it. He made reference to using funds for regeneration, levelling up, net zero. He even used children's homes, which this will come up in presentation that you're going to hear later on from David at Hyman's as well. So he'll talk about some of the, the contextual background too. So nothing really that new, but what they're really saying is, how can we, encourage is not the right word, but almost direct local government pension funds into UK PLC. So investments into the UK as opposed to elsewhere to support UK economic growth.
Could I ask a quick question?
Sure.
Rachel Reeves, who I have great admiration for, is she involved in this in any way?
The
She,
deputy leader, wouldn't it? The
We
community.
should declare an interest at this point. My grandmother's Reeves and a member of the Reeves family, as is Rachel.
right. Another interest, didn't you, when you went to
Simon.
Simon Hall? Yeah.
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 The other side, my mother's side of the family.
That's where you get your economic brains. But is she actually involved in this? Because at the end of
She
the
will
day,
be.
what we're talking about is money. The government haven't got any money. So they're looking around to find sources of money to invest Labour or Tory,
Exactly right.
what they want to do.
And the
That's
200 billion of local government pension funds is
Is-
low hanging fruit.
Yeah, it's very tempting.
It is, and what they know that the government balance sheet is not strong enough to be able to direct funds into their priorities. So they're looking for what they might call private capital to go into it, and this wouldn't sit on the government's balance sheet. And so that's why they're looking for alternative sources. Now, Kevin from Access is closer to this than I am, but I've been speaking to him recently, and he's saying that Labour are talking about what is being described as a national wealth fund. So, and you could envisage that would work in a way that pools actually invest into a national fund that has got obviously some credibility, and it may have some security attached to it because it will be a construct of government. And then,
Chris, just to add, I believe there's a figure floating around of, is it 7.3 or 7.9 billion on that?
There's news and releases on it this morning.
Yeah, well, that's.
so, I mean, this is emerging stuff, but ultimately, I think the direction of travel is some form of consolidation. You know, consolidation of whether that be done at a pool level, you know, pool consolidation, whether it be individual pools investing into a national wealth fund, or whether it be at fund level. It's not that clear yet because I think it's early days, but overall the direction of travel is some form of consolidation to try to get investment into UK PLC. And the final comment, he left with two final comments, really. One was, Treasury are really in support of this, and have you ever tried to change Treasury's mind?
Ministers can't.
Exactly. My department point of view.
Has it ever worked
No,
when they are firmly behind something?
You can outmaneuver them occasionally. I managed it a couple of times, but it's hard, very hard.
And the only other thing he said was that change is coming. If you want to try to influence and shape the change, get involved. Otherwise, it will be done to you.
to you.
So, lovely way to finish his roundtable meeting on that note, I thought. But anyway,
At least it's clear.
it is pretty clear, but we have got a new government now, so there may be a nuance to it.
Mm.
I mean, my only question there is the legal implications. These are pension funds for the 5,000 people on the Isle of Wight, for example. Can the government, without proper legislation, and I don't know how they'd get that through, just stipulate, because at the end of the day, they're pension funds for people. Can the government couldn't do that to company pension funds? They couldn't go to, say, BP and say, we want X from yours. So why should they be, or how could they say that to us because we happen to be local government?
Because we come under the Local Government Act and not under an independent pension statute.
Yeah.
Yeah, but it's, I mean, some people are threatening JRs, but anyway, sorry.
No, I mean, it's a really good point, Councillor Churchman, and I kicked back quite strongly when he started to talk about it. Because when he was talking about it in more detail, he was also talking about, well, he felt that pension funds could have a different approach to return and payback. So my opportunity, I said, that sounds inconsistent with what you said earlier on about fiduciary duty.
Exactly.
That's what I was thinking. Exactly what I was thinking.
I did say if the investments in UK PLC were of equal merit to those that we would otherwise as a fund invest in,
Yeah.
I think it sounds as though that there would be no problem associated with that.
You'd have to.
I said, if you're asking for pension funds to go further than that, I have no license, we would have no license to do that. We'd have to go back to our own pension fund and have them consider what their risk appetite is and how they would then seek to take that forward, but got no license for that at this stage. So
Absolutely.
didn't really argue. I think he
That's
noticed.
true, isn't it?
But it does, you're right, absolutely right. It all comes back to, for me, it all comes back to whose money is it and fiduciary duty. That's the end of my presentation.
Any last questions for Chris? Steve?
Yeah, I know it's early days and we've got a new government, which I support. I could declare an interest. But I just wondering if there's an analogy between what we currently do in terms of, say, if we buy stocks or shares, or we buy government bonds or private bonds. We buy government bonds and expect less return because they're absolutely secure. If we were directed, as it were, to invest in this government wealth fund or whatever we want to call it, would we have that added protection that we were investing in some projects or whatever that are underwritten by the government and therefore somewhat safer than if we were just investing in the private sector? I was wondering if there is that sort of angle to it.
Well, that will come down to our risk profile and our discussion about it. If the government was to say this sovereign fund is going to guarantee you inflation plus 5%, we might find that as the council relatively attractive, but we don't know what the terms of it will be yet.
No.
So there is nothing currently for us to consider. It's simply a notion. I wouldn't even call it a formal proposal. It's a notion. And I suspect it will probably take some time to come to fruition. The bottom line is that the UK has spent all its reserves from the past. It's sold everything that it has from the present, and it's borrowed into the future. And having exhausted that, you have to scrabble around looking for other funds. And you can put everything down to growth of the economy, which seems to be the mantra at the moment. But any other low-hanging fruit is going to be grasped at to try and secure the investment that they need to do. So I think it's probably a watch this space.
I think that's right.
So thank Chris to keep us up to date with all the developments and news that comes out.
The one attractive that, or what appears to be attractive, I know Louise just reminded me we've got David Walker on the line, and he may know more than us. But one potential attractiveness of it probably doesn't require significant legislation. Well, it wouldn't require legislation to go along the lines of a national wealth fund, whereas some of the other proposals around fund mergers, pool mergers might get stuck in the legislative process. So if expediency is the name of the game, then perhaps it's got some legs.
Is there anything you wanted to add to that, David?
Hi there, can you hear and see me, Chair?
Yep.
Just that one of the articles that was out this morning, there's a task force looking at the National Wealth Fund, and there was a quote that they called for it not to be loss making. So in terms of meeting your fiduciary duty, that would be the very bare minimum that I would expect, that it would not be loss making. So clearly still early days in terms of what that would look like, but yeah, it would definitely need to stack up from the fiduciary perspective. And
in real terms, David, not to be lost, real terms.
Ideally, yes.
Thank you. Right. Anything else on this agenda item, people?
Don't think you're going to get your 5% back.
See where that goes. Item 6 then on the agenda, which is the report from the local pension board. We've all got the papers and the minutes that came out from the last meeting. I think a number of us were there or even watching it. Is there anything you wanted to add, Martin, to that? To the last meeting of the pension board? It did focus very heavily on IT security, didn't it?
Yeah, yes, that's right. Can you hear me, Chair?
Can.
Yeah.
Yeah. Yes, that's right. There's, since I've been chair over the last couple of years, there are three areas of risk that we've really been concentrating on, and a lot of those have been addressed already by Chris Ward. That's resourcing and cyber risk, and also ESG responsible investment, where we think there's been ground to make up. So it's been positive listening to Chris Ward on resourcing. It's as I say, very good to hear the progress that's now being made. I know the issue will be along the lines of training, which is difficult when you're very busy, got new staff, and having resources to train, and it's a crucial area, and the pensions manager will know that's a significant task ahead. And I think training is really important on the admin side, not only for the current staff members who are new to be able to take on these tasks that are currently being done by the third-party contractor. It's a pathway for development for the service to have an intake of local talent from the Isle of Wight, to be able to train them up who are new to pensions, and they'll be invested in the service. So it's really important that we can get to a stage where we can roll out training. So, as we've spoken about the cyber risk, it was really good to have a talk from both Hayward's, the software supplier, and the local IT manager. It's at a time when we know that the NHS is losing 4,000 operations because of ransomware attacks. It's really good to get that cyber assurance that all parties have signed up to following the ISO data security protocols, and have disaster recovery plans in place, and are meeting those data security objectives, which was very reassuring, and we'll keep on hearing back on those areas, because as we know, it's not a question of if cyber attacks happen, it's when they will happen. And we heard from the Isle of Wight the data security manager, that the Isle of Wight Council, it was under attack, particularly over the election, and on the election side, foreign agencies trying to access systems. So we know they're out there, and as I say, it's only a matter of time which they'll come after pensions. So it's really reassuring to get those assurances. And on ESG, responsible investment, obviously we're talking about that later in the agenda. So that's another positive move. In terms of KPIs, I would probably look at the retirement processing of the KPIs, as Chris Ward said. The overall performance level is about 89%, but if you look at the retirement processing in those 3 months that we looked at, it's of those 300 tasks, it's between 29 and 25% that weren't completed on time. So that's something the board will continue to monitor. Really important that we get pensions paid to members on time. So that's something we will watch. And the other area of concern that we mentioned in the board meeting was around as the payroll provider for several of our employers, Strictly Education, and the lack of data coming from them, which potentially could affect the fund being able to send out annual benefit statements, which is a statutory requirement to send out for those members. So we are concerned about that, and we recommended escalating to the managing director of Strictly Education to try and move that on. So that's a brief summary of what was discussed in the paper, and happy to take any questions.
Thank you, Martin. Are there any questions for Martin? You'll all have read the paper in advance and seen the minutes of the board meeting as well. Barbara.
I'd like to make a comment. Since I've been on the pension board, I think it's 2015 when it was first put together, the cybersecurity has always been an issue that we've never really had answers from. And I'd like to thank Louisa for organizing it, because the assurances that we were given, the cybersecurity is first class, and I'm very, it puts my mind greatly at rest that what has been put in place.
Yes, I think we were all impressed by the level of commitment that was given. Quite astonishing, really. normally these things are given with some degree of caveat, and this occasion not. So
Quite often find on the commercial side, they do it because they have to sell their product. But on the council side, sometimes they're not quite as vigilant, but I think what we have in place on the council equals they would.
okay, Karen.
Just because I'm the cabinet member for ICT, I'm very aware that they are excellent. Yeah.
Good, thank you. And thank you, Martin. Right, on to the
Thank you,
next
Chair.
item, which is the localism and responsibility investment. I think this is over to you, David. He's back already.
Thank you, Chair. I'll just see if I can share my screen as well, although I think the slides are in the pack. Give me a second. Can everyone see my slides okay?
Yes.
Yeah.
Cool. So quite a topical subject to cover today, given the discussions that we've had already this morning. But we've prepared a kind of short slide deck looking at kind of two main themes on the investment side. One, and I say very topical, given kind of pooling and some of the discussions from Chris there on kind of localism and thinking about that from an investment perspective. And then also looking at responsible investment considerations, where the funds got to date, and again, reflecting some of the later agenda items on the risk register and potential actions to consider on responsible investment related matters. So if we start thinking about, I suppose, localism, local investing, it probably makes sense to take an initial step back to think about the kind of overarching objectives that you have as a pension fund and as a committee. So the following big block of text that was shown here is taken from your investment strategy statement that was updated earlier this year. And you can see the start point of that is really the primary objective, as you know, is to provide those pension benefits to your members. So in terms of the committee aims, it's about setting a funding approach that makes sure you can pay those benefits, but sets a balance between the extent to which you can meet that through the assets and the investment returns you generate on those assets, and the contributions that you can have coming in from employees and employers. So it's finding that kind of right balance in terms of the level of investment risk that you take and the level of funding affordability that means for the employers and employees. So to help frame that, you've developed a set of investment beliefs that have various views on risk, diversification, responsible investment, and how you incorporate that in your decision-making process when you're setting investment strategy. So if I then kind of take it down a further level in terms of some of the underlying requirements that entails, firstly, you still have this kind of overarching box, the kind of principal objective of being able to pay those benefits, and then ideally keeping your contributions affordable, but also stable over time. But then you have these sometimes conflicting or kind of challenging underlying requirements to balance these different factors. So if I start on the left-hand side, in order to keep those benefits and the contributions affordable, one of the key advantages of the LGPS being a funded scheme is that you're able to generate the returns that you have on those assets. So to keep contributions affordable, you need to generate a certain level of growth and the returns on your assets. On the right-hand side, there's a bit of a balance though, because to try and keep those contributions stable as well as affordable, you also have to think about the level of risk and the volatility. And in particular, we've kind of highlighted what we've called the secondary contribution rate. So you have kind of two different sets of contribution rates, the kind of primary rates, which is about the future service costs, but also the secondary rates about a potential surplus or deficit in the scheme and trying to keep that manageable. So although you can take growth risk, you need to think about the volatility and the impact that can have on your ability to maintain those kind of affordable and stable contributions. And then increasingly, we're seeing this kind of middle requirement as the scheme and the Isle of Wight pension funds continues to mature, the net cash flow position will gradually shift. So more and more those assets, you'll need to think about how you can actually pay out from those assets to meet the benefit out goal. So again, think about assets that generate you a nice regular source of income to be able to meet those cash flows, but also add some stability that you have to the investment return profile to kind of steady out the volatility through regular and observable income. So that's the way that we've kind of structured the investment strategy, and you've set the strategy across those kind of three main asset groupings. So in terms of the growth asset allocation, the biggest part of your allocation is still in listed equities, with a target allocation of 50% of your assets. And that has that key driver of generating that kind of long-term growth in excess of inflation to say maintain the returns and drive the affordability of the contributions. Over recent years, you've been building this allocation to income assets, and there's a mix of assets there, property, infrastructure, and private debt, but all with a more visible source of income to diversify the return profile. And all of those assets are a bit more illiquid compared to the listed equities. So again, part of the return profile, you benefit from that illiquidity premium from being able to invest with a long-term investment horizon, and I say help the overall return profile there. And then the final element which you've been building up more recently, which I'll touch on in the next agenda item, is the protection assets, largely government bonds and corporate bonds. Again, provide income, but also greater kind of funding stability by providing you some exposure to interest rates and matching to some extent the way that you actually values your liabilities. Now, in the last, say, 10 years, we know that government bonds were not offering you a very attractive return. Yields are very low, but in recent years with a higher inflation environment, we've seen a real upward shift in the level of interest rates and government bond yields, and therefore you've been reallocating back into fixed income assets, also as the funding levels improved, so kind of providing some more protection and stability to that improved funding position that you've developed. So that's the kind of structure of the investments and how you've thought about it to date. Now, the next part starts to think about kind of local investments and some of the pressures that you're seeing from government, whether it's the previous government or the new government, as we've discussed earlier today. There's still this continued focus on the LGPS and how the assets of the LGPS funds should be invested. So I've highlighted kind of three of the recent areas of focus that we've had. The primary one on the left-hand side is pooling. So it looks like this is unlikely to shift much under the new government, but the consultation that was undertaken last year had proposals covering the three areas that we've outlined here. So the first on the left is that continuation of pooling, both the pace and the scale of pooling. So initial aims is to have all listed assets invested through pools by March 2025, and that you need to set out a plan for each of the parts of your allocation as to which is going to be pooled, under pooled management, and a comply and explain approach for any assets that you don't have within the pool. So that looks like a continued area of focus. The one that might be a bit more uncertain under new government is the focus on levelling up. So again, that as part of that consultation, requiring funds to set a plan to invest up to 5% of assets in levelling up in the UK. And I think there were 13 different kind of strands of kind of levelling up, and the government aims. Not all of them, I would say, were investable from a kind of financial perspective. But again, a kind of proposal or for you to set out plans to show how we're investing or investing new money to reflect some of those levelling up aims and objectives. And then the third one that they had put in, and this was stated as an ambition, and it's linked to Chris's comments earlier of the government wanting funds generally to invest in UK growth capital. Still a bit of uncertainty as to what they meant by UK growth capital, but certainly in the consultation requiring funds to set an ambition to invest 10% of their funds assets into private equity. So again, that was an ambition, not a kind of hard requirement, but showed the kind of direction of thought there from the government in terms of where they want to see LGPS funds investing. Now, along the bottom of this line, I've put a kind of question mark on kind of local investing, because arguably you could have local investments in all three of these areas potentially. But it's how you would make an assessment as to if you wanted to allocate to more locally focused investments, where that fit as part of the overall strategy and the types of objectives that you would want to have for a more locally focused part of your investment strategy. However, I suppose we're saying that there have been other things that the government have mentioned in terms of LGPS monies. Firstly, there is a kind of regulatory limit of authorities not being able to invest more than 5% of your total investments linked in entities which are connected to the authority. So that's an existing regulation that's been in place for some time, where there's more that direct link with the local authority. However, the government had also come out with a few other statements. So in the spring budget had mentioned local government schemes potentially unlocking investments in new children's homes, which I think came slightly out of the blue and was maybe more of a left field suggestion in some of the recent proposals. But as part of the Mansion House reforms, again, as Chris has highlighted earlier, that focus on UK growth, encouraging LGPS funds to develop plans with the British Business Bank on how they might invest to support UK businesses and what the opportunities are there. And then more recently, and again, this maybe kind of highlights a bit the uncertainty of what they mean about kind of UK growth capital with the new reporting requirements to set out the amount that you have allocated to UK listed equities, UK government bonds, then UK infrastructure, and then private equity within your accounting guidance. And see, it's how much arguably some of those asset classes are directly linked to UK growth is a bit more debatable. But that's a range of things that we've seen, and then as has been mentioned earlier, we've now had a new government come into place. The focus and the headlines today have been on that National Wealth Fund, focused on primarily on the climate transition. Hopefully there are investable opportunities there, because I think there is still a difference in funding the transition and actually generating returns through investments in that as well. But again, that's the kind of latest that we've seen in terms of proposals, but unclear as to what the direct link between LGPS funding and some of those proposals might be. So I say that's where the kind of government focus has been. But if we think about local investments more on a kind of standalone basis, what are the different considerations that you would have to take into account when thinking about a more locally focused investment? So next couple of slides, I've highlighted some of the things that you would have to think about when considering a more locally focused investment. And the first, as we probably saw with the government focus on infrastructure and pooling, is what do you mean by local? So is it purely within the Isle of Wight? Is it a more regionally focused investment, or is it UK wide? And that has implications for kind of risk concentrations, the size of the opportunity set, depending on what your definition of local is. As was highlighted early in the meeting, a key consideration with any investment, and in particular for a local investment, is does it stand up from a fiduciary's perspective in terms of the level of returns relative to the risk that you're taking to invest in that opportunity. So is there a real specific return premium that you're looking to capture, but also has that local focus? The risk considerations in local investments can be a little bit more complex in that it could be a more concentrated investment or have more specific risk factors. Alternatively, it could have some really attractive allocation characteristics that you're not getting from elsewhere as part of the kind of global opportunity set. So again, different considerations there from a risk perspective. Another consideration is where it fits strategically. So would you be thinking of kind of carving out a specific allocation to more locally focused investments, or would you do it on a kind of asset class by asset class basis? So would you think about, you know, a proportion of your listed equities having a more local focus, the private debt allocation, or your infrastructure allocation? So there's different ways in which you can construct that. When you are thinking about local investments, how you kind of compare them, it can again be more challenging because they can have much more idiosyncratic risks or be quite specific in their nature. So again, it's making sure that you have a consistent framework for assessing each investment on its own merits and whether it stacks up from that kind of risk return perspective. Another area is assessing impact, and it's actually something that we've been spending quite a lot of time on as a firm in terms of how you actually measure impact. And one of the potential frameworks that we look at here is the kind of AIM framework. So the A of AIM is additionality. Are you investing in something that is creating something that wouldn't happen if you didn't allocate capital to that particular opportunity? Then you've got the impact and the materiality as well. So a range of factors in terms of thinking what impact are you trying to have with your investments and how can you kind of measure that on an ongoing basis. And there can also be kind of negative impacts as well if it's a very prominent local investment and it doesn't go to plan, that there could be kind of reputational risk to manage around about that as well. The kind of next kind of set of things to consider. So firstly is about scale. Is investment there in scale to allow you to access in a kind of institutional manner that is properly structured in a way that generates returns that you need, gives you the kind of liquidity profile that you're looking for as well. Another is about the use of third-party managers. So are there managers out there that have the knowledge and expertise to invest more locally and generate returns from that perspective? And even getting kind of access to the market, are there that institutionally robust and regulated opportunities there for you to be able to allocate capital to? And I think that's important because I know there's kind of a lot of talk about even that kind of national wealth fund, and I made that slightly joking remark about it has to generate a profit, but it's finding opportunities that have that robust nature and we can stand up to external scrutiny. The next one is on governance requirements, and I suppose given the discussions on resourcing, this is one that's certainly not to be overlooked. It can, and the resourcing governance together, and that it can be quite intensive in terms of the time and allocation spent relative to the size of the allocation as part of the overall fund's investment strategy. So again, careful consideration required about the time and effort spent to considering and allocating to these types of potential opportunities. I would note that I advise one of the largest funds in the LGPS. They have carved out a kind of separate allocation to what they call their direct impact portfolio that has a more local or certainly UK focus to the way it invests. But they have 3 full-time members of the investment team that review, assess the potential opportunities and kind of monitor that on an ongoing basis. And even there is all through third-party managers, but it just gives you a sense that's kind of up to, well, currently 5%, but could be up to 7.5% of their fund, but is a big commitment from a resource and governance perspective as well. So overall, just to kind of round off on the kind of view on local investment. So there is a regulatory framework in place that allows LGPS to allocate to those more locally focused investments, but very much within that overall framework of the overarching objectives and requirements that you have of being able to pay pensions and be able to take the right level of investment, return and risk. The recent government focus on levelling up could be potentially aligned to local investments. But as Chris has noted, the onus is really on investing to support UK growth. And it has been at that kind of UK level seems to be the overall focus of how can we get pension funds like the LGPS to invest more in kind of UK growth. As we've outlined, local investments, can meet kind of financial and local aims, but there are those kind of range of other considerations that we've highlighted in the previous slides that need to be kind of carefully managed. And the kind of final point about proportionality is it also needs to stack up from a governance and resourcing requirement. So kind of overall, local investments is an area in which LGPS funds can allocate to, but careful consideration is required on the kind of risk return balance and the overall kind of resource requirements that entails.
That's a good question.
Thank you, David.
Could I ask a question, David?
Yes.
It really worries me about this point of investing in, the government wants us to invest in children's homes. However, funds that invest in children's homes require a return of 5 or 6%. Now, as an island, we send a lot of our children off island to be cared for. That means that 6% or 5% that of return will then be added to our council expenses. Has this been thought about?
On the children's homes, I certainly don't think so, Councillor Churchman. I think that seems one of the least likely in terms of where they would actually ask you to allocate money in the end. The broader kind of UK growth capital, I think even there's still a kind of lack of clarity as to what they mean, given that the reporting guidance included UK listed equities, and the companies that are listed in the UK, a huge chunk of them, you would argue, a lot of their profits are not UK focused and are not about UK growth. So I think it's difficult to see where that would, where this is going specifically. But certainly, yeah, I don't think that the children's home one certainly came a bit out the blue, and I don't think has been kind of fully thought through. And I think the focus will be, as Chris said, on that kind of UK growth capital, but it's finding opportunities there that have to stack up from that fiduciary perspective that can meet your return requirements and are manageable from a risk perspective as well.
Of course, we add to that Red Funnel, which is in apparently bad trouble. Can you find us, please, an investor for Red Funnel? But at the moment, every time Red Funnel has changed ownership, different pension funds, because it's a cash business, the fares go up. So, this internal sort of investing locally it's not a stable way of running things. Anyway, we need an investor, please, David, for Red Funnel.
So I don't expect you to answer that, David, but Steve has a question as well.
It's on that very point, actually, because if you go back to when Maurice Barton was the leader of the council, he actually suggested the Isle of Wight pension fund should buy a ferry company, reduce fares and still make a very healthy profit for the fund. I think it's interesting that those sort of possible investments are now on the table, and I think we should view things positively if those sort of opportunities. Obviously, we've got to manage things, we've got to take into the right considerations, the needs of the pension fund, but I think there are local investment opportunities that we could consider. So I think, although it sounds a bit pie in the sky, could we run a ferry or own a ferry company? I don't think it's an impossible option for us to consider.
Oh, I'm sure there are many around the table who would agree that it's not impossible. But it's certainly not our core business.
Thoroughly improbable.
Right.
I think sure. I think just on Steve's question, it goes back to some of those considerations. How is it structured as an investment? Is there something that is actually investable there that has a clear risk return profile? What's the idiosyncratic risks? If a ferry or two ferries break down, how much is that going to impact that return from that single investment, and how does that compare to the overall size of the allocation? So at the moment you've got a global well, you've got two allocations to infrastructure, but they're kind of global in nature. You're part of a a massive fund in the case of the JP Morgan fund that has the real global reach and a kind of thoroughly tested platform. When you get kind of down the scale in terms of regional investment and kind of scale as well, yeah, it just kind of shifts in terms of some of those risk characteristics that you need to consider.
And perhaps the new company, which starts operation in a couple of weeks, will change the dynamics of that. So I saw their ferries arrived anyway, so they should begin operation in 2 weeks. I'm told. Don't know if many of you have seen the boat yet, but
I've only seen the pictures of it.
Kraken.
Yeah.
Kraken services. Anyway, thank you, David. Anything else for David on this item?
Sorry, that's the first half, Chair. So I've got the second half, which is about the responsible investment part. And just say, just be thankful you don't live in Scotland and have to deal with CalMac ferries. So I'll not go into.
You're not investing in those either, no? Okay.
So the second area, and this links to some of the later items, which I think Louisa is going to cover in the risk register, is we wanted to just give a brief update on responsible investment, some of the key considerations here, and where the fund might go next in terms of a kind of work plan. So the first bit here again has been taken from your investment strategy statement and covers your kind of broad principles on responsible investment in terms of acknowledging that ESG, environmental, social and governance issues can have a significant impact on performance. There's a need to balance both financial and non-financial considerations and when thinking about these issues and the impact that they can have on your investments. As I mentioned earlier, you can take a longer term investment horizon, and that should be factored into your thinking about responsible investment considerations. And that should be, companies that are well run from an RI and ESG perspective should be expected to outperform over the longer term. And then that the kind of focus on the work that you've been doing with access and particularly on stewardship and engagement issues to build that into the way you invest on that kind of 50% of the fund as the listed equity allocation where you have those voting rights. So that's a kind of broad statement of where you are at the moment set out in the ISS. In terms of how that's reflecting in the way that you've invested and the extent to which you have pooled your assets to date, we've set out on the next slide. So as you can see, the vast majority of your assets are through Access ACS sub-funds or under some form of pool governance. So on the listed side, we said, the government aim is to have all your listed assets pooled or under pool governance by March 2025. So you already meet that requirement. So you have a majority of your assets, listed assets in those ACS sub-funds, and then the allocation with the UBS Climate Aware Equity Fund, where that's under Access governance. There are also plans to transition a further kind of 20% of your assets into pool or pool-aligned solutions. So on the infrastructure side, you made the allocation to JP Morgan, which is pool-aligned, and then the Partners Group Infrastructure Fund, which is closed-ended. In due course, as the money kind of comes back from that, there'll be the opportunity to reallocate further money to the JP Morgan Fund. On the property side, again, a decision was made at the last committee in principle to move to the new Access solution. So again, there's just a kind of timing factor in terms of the creation of that new solution with CBRE, and then how we transition out of the Schroders mandate, given the kind of cost and the need to carefully manage the cost of transitioning across from the Schroders property mandate. And then again, the private debt solutions, where there are new solutions being developed, again, you have closed-ended allocation. So as the money kind of comes back from them, you can recycle it back into the new Access solutions where available. On the right-hand side, we've also highlighted some of the RI considerations and the work that the committee and the fund has done over recent years. So in 2021, the fund carried out an initial carbon footprinting and ESG analysis exercise on your listed assets. As part of the last investment strategy review and actuarial valuation, you carried out some climate scenario modelling work. As I've mentioned as well, you've carried out some kind of detailed work with access and developing the RI policy around about stewardship and voting. And then also as some of the recent manager appointments with the Pantheon Private Debt and JP Morgan Infrastructure, that ESG considerations were carefully considered as part of those selection processes. And then the final point to note is of the strategies, there is one that has a specific climate objective, which is the UBS Climate Aware Equity Strategy. So ESG considerations, although they're something that you'll see in the risk register, which Lisa will discuss, you have considered ESG quite considerably in the evaluation of the investments, and we can expect that to be a continued and ongoing process. So in terms of potential next steps, so I've mentioned the investment beliefs. We believe that there's probably an opportunity to review and update those beliefs on responsible investment to make sure they fully reflect the views of the committee and how that might shape the way that you implement your investment strategy. On the risk side, there's potential to separate RI and climate risks. In particular, kind of looking at some of the next steps, although it has been delayed, we still expect that at some point the LGPS will need to report against the Task Force for Climate Related Financial Disclosures, so TCFD. So that will require you to set explicit reporting requirements and targets on different climate characteristics and objectives. So again, further discussions potentially to be had on what those targets and metrics might be, and whether the fund wants to set a potential ambition on net zero targeting as well. These things roll round pretty quickly, but we also have the 2025 actuarial valuation coming up next year. So again, we expect there will be opportunity to incorporate climate modelling as part of that review. And then finally revisit the risk register to reflect some of the work undertaken on our RI. So happy to again pause there and take any questions, but those are some potential next steps that we've outlined on RI.
Questions, Joe?
It's more of just a bit of extra information. There's a meeting for access funds, a virtual meeting next week relating to TCFD reporting that Waystone, as the access operator, are undertaking. So I've signed up for that, so I will be able to get a bit of more information of what they're producing on our behalf on that. That was all.
Right. Any other questions, anybody? No? Thank you for the second half, David, again.
Thanks, Joe.
And I believe you're carrying on to the next one, which is item 8 on the agenda.
Yeah, so I think there's the next two items. So I'll start with item 8, which is an implementation update. So the main point to note here is to give you an update on the progress on the reallocation of the assets that were in the Baillie Gifford Diversified Growth Fund, ACS, within the Waystone, the Access platform, and transition of that to the Royal London Bond Fund. So I can confirm that I think it was the 17th of June, the majority of that switch was made. So there was a 57 million switch from the Baillie Gifford DGF into the Royal London Bond Fund, ACS. There is excuse me, a small residual amount to be swept up, which we expect will in the next week or so. That's a much smaller amount. The reason is because we were kind of buying and selling on the same day in order to maintain market exposure. We had to kind of fix a monetary amount in advance. So we left a little bit of headroom to allow for market movements around about that. And then the ACS sub-fund is also going to be wound up. So we need to leave a little bit of money back for that. So majority of the trading is now being completed, so you're more fully up to your allocation in bonds. Diversified Growth Fund will be now down to 0 pretty much, and then that final amount will be wound up in the coming week.
At least the next one.
There you go. Any questions to David on that bit? Nope. Okay, carrying on, David.
Okay, have I frozen, Chair?
Oh no, you're going again now.
All right, cool. The next item was just to give a quick market update. So as you might expect, given the timing of the meeting is very, very close to the quarter end, we don't have the full usual performance reporting to bring to you, but I've put a few slides together just to provide an update on market movements up to the end of June. So in terms of kind of Q2 highlights, the first thing was some continued kind of limited but positive signs of growth. So Q2 data showing that the Eurozone and UK had officially exited technical recessions in Q1. So again, positive signs of growth. I suppose the other kind of key uncertainty that we have at the moment is around about inflation and interest rate expectations. So we have seen inflation start to fall, US remaining a little bit above target, UK getting back to target for the first time in almost 3 years, but with the expectation that the second half of the year it might start to ease back up again slightly. And again, even in the Europe, inflation kind of over kind of exceeding the target. I suppose ECB did make a move to reduce rates. The UK and US kind of holding steady just now, but that's the uncertainty is over kind of how quickly or when we might see some of those rate cuts. So still expectations that there may be a rate cut this year, maybe two, but much more kind of muted in terms of where we were earlier in the year. I think the start of this year there was 6 rate cuts priced in over the course of this year. That's very much now diminished due to the stickiness of inflation. So although it's been coming down, not quite as fast as people were expecting. And I say the UK might start to rise again in the second half of this year. So in terms of how that's been reflected in market returns, what you've seen is generally pretty positive conditions for equity markets. UK up nearly 4%. Again, global markets up about 3.5%. And then for the first half of 2024, kind of nearly 7.5 for UK equity markets, and in excess of double-digit returns for global markets. Bit of variation kind of across the various regions, but generally pretty positive. Bonds, with the expectations that you're not going to see the same pace of rate cuts, we've seen bond yields rise, and as such, some negative returns from the bond assets. So on both conventional gilts and index-linked gilts, negative returns over Q2. Credit slightly negative, so although they also impacted by the rising expectations of kind of interest rates and bond yields, the spread that you get on corporate bonds has continued to tighten overall over Q2, resulting in that kind of more marginal negative performance. UK property market has started to stabilise a little bit in terms of valuations, so some kind of small positive numbers coming through there over the course of this year as things start to ease a little bit and the interest rate environment starts to improve. So those were the key highlights. I see within equities, a lot of the kind of key drivers is still the dominance of the technology firms and the focus on AI. On the bond side, it's all about those kind of interest rate expectations are driving overall performance. So those are some of the key highlights. And again, happy to take any comments or questions you might have.
Me again.
Minutes.
Last week, I attended the pensions conference and I asked different fund managers what they thought would happen. This was before the result of the election, by the way, and they, quite frankly, didn't see much change across the whole market system. So you would maybe agree with this. However, when the election obviously was announced, I think the stock market immediately went up, David, because this is what the fund managers wanted, was a stable political regime. We've been living in an up and down thing. And apparently in France, the stock market has dropped because they're in such turmoil. So just be interested in your comments on this. And of course, we now have a chancellor, as I've said before, who is an economist. Thank you, David.
I think in general, consider, I think markets like stability and kind of certainty. So again, I think the election being brought forward, I think there was a general, given the polls in advance, it looked pretty clear in terms of the direction that that would be heading. And I won't use the kind of Rizla packet analogy from earlier on, but it did seem there would be kind of continuation and kind of stability of some of the kind of policies, financial policies. So again, I think the markets had reacted reasonably positively to that in terms of that certainty, in terms of continuation of some of the policies, and no kind of wild mini budgets that might send things off in a different direction. So yeah, I think definitely having that stability seemed to be reflected positively in the markets, and that's been reflected in the numbers that have come through since then as well.
Right, any other questions on this item? No? Good. Moving on to the one of the highlights of the day, the draft financial results.
Thank you, Chair. If I haven't given you the full accounting pack because they are still subject to the finalisation of the audit. And actually, to be honest, after I sent these through and they were published, the auditors then came back and said they wanted to do a slight change. So it's I'm glad I didn't do a full pack. I've given you the fund account balance sheet, so you can see we've had a positive increase in net assets over the year. And I've also given you a breakdown on page 37 of the movements between the prior year and the current year, just so as you get a bit of a feel for why things have moved as much as they have. And I'm hopefully the explanations are fairly self-explanatory, but I am happy to take any questions on this. For your information, the amendment about the auditors have requested is the initial investment into the JP Morgan Infrastructure Fund, which went through on the 28th of March, but wasn't actually actioned in JP Morgan's books until the 1st of April. It's being moved from investment assets into cash. So that's just a movement on there, but it will have a knock-on effect on other schedules further down the pack. But that's give me something to do when I come back off my leave. But apart from that, I'm happy to take any questions if there are any.
I'd like to thank Joe for not sending us out all the way. Something very helpful. Just a sort of observation, the management expenses have gone up from 6 million to 7 million, which seems quite an increase between the 2 years. Particular reasons for that?
One of the main drivers for that was the actual increase in management fees, primarily for partners, which is our initial infrastructure fund. Last year, we started investing in it in July, so it was a slow build up last year. Sorry, not last year. 22-23. 23-24, which is the year being reported on here, the fees increased. So because our value of our investment had increased, and they are based on the assets under management. So that's the main driver for that. So that's 726,000 of the million. There are some changes relating to obviously the costs that were discussed earlier in the meeting about the admin support costs, investment consultancy. We also incurred some legal fees for taking on the two new portfolios for infrastructure and private debt. So yeah, it's a bit of it's pluses and minuses. That's the main driver.
Chris.
I was just going to mention that Joe talked about an adjustment, but it doesn't affect the bottom line.
Yeah.
The bottom line stays the same. It's just a reclassification.
Whether on that day it's in equity or in cash.
Yeah, exactly. I didn't want people to go away with the impression that the bottom line has
No.
changed. The overall
Not at all.
performance is as set out in the statements, but the way it's categorised, the investments is slightly different.
It's purely going to be a movement on the balance sheet rather than through the fund account.
A very satisfactory year.
Yeah, challenging towards the end, especially with the auditors. I think they get younger every year. That's the problem. I'm sure. It's a bit like policemen.
Like the rest of us who stay the same.
Definitely.
All right.
A few good assurance though.
Thank you very much, Joe, for that one. Very pleasing. Next one then, risk management policy update is back to Chris. Oh, is it?
Yes.
Chris on here.
It has
Oh,
got-
Chris, he's the sponsor.
Sponsor. Who is it? You're only going to get away with number 13 on the agenda today, but to get a double dose.
Yeah, so in short, it's risk management policy. It's a refresh. It was due an update years ago. So it was one of the first things I've done. I've had a look at the risk management policy. Obviously, we have had TCFD come in since March. So what we've looked to do is align, because actually it's one of the big areas of change in TCFD, risk management, cyber, another hot topic in scams and fraud and things like that. So it was a good policy to pick up first to have a look through. So yeah, so it's aligned now, if you like, to TCFD. So it's got all the best practice elements in there. I would point out a couple of things, just as a few tweaks here and there. So if you've read the policy, for example, in the area of around methodology in section, I think it's 7.1, look at the notes. As Chris was saying earlier, we're going to be doing a review of the risk register, and it's just to remind everybody that we do rely on the risk management framework, or we sit within the council, so we sit under the risk management framework. So there are more references back in to remind you that we are under the risk management framework of the Isle of Wight Council. Obviously, there are certain things around methodologies that we use, so it's just a reminder. So again, it's just a nod to some of those elements in there. Again, when you look at the Isle of Wight Council's risk management framework, one area around how you categorise your risk, it's all making sure it's very clear. And what are you trying to actually achieve at the end of it? Your mitigation, what are you actually trying to do? So, and having your title very clear, rather than just saying climate change, it's actually saying, well, what are we actually trying to do about this? So it's trying to frame it more in outcomes. So what is the risk that we're worried about? And we're going to fall behind. What is it? Are we getting stranded assets? So as I say, in the risk management policy, that's another area. So I've just gone back to the risk management framework and spoken to the ladies on team, the risk management team. And as I say, there's a little bit more in there just to clarify around the methodology that we'll be using to take a step back and look at the risk register. As I say, it is around the framing. Also, anybody should be able to read our risk register and understand what it means. So it needs to be read in layman's terms. So we need to make sure it's very clear and concise in what we're saying. So again, that's what we will be doing as a team, and that's what we're starting. So again, things like the cyber risk is on the register. We're not taking it off. Again, there's a big exercise happening in the council around the framing of cyber risk. So again, the wording and what are we trying to actually do? What's the outcome and what are our mitigation? So again, we're working with the IT teams on cyber and looking at the way the risk is framed on the register. So that's reflected back into your risk management policy. As I say, around making sure we're all clear around the framing of how things get framed and put onto your risk register in the first place. And as I say, the other bit then, and nice to have if you like, it's something that you're already doing, a little bit of tidy up around TCFD stuff is, the big thing is your reliance on assurance reports. So the reports that people like David give, Chris give, Joe's, Matt, different people, we have the IT guys coming in. These are your big tools. So yes, you have your risk, but ultimately you need to hear and you need your reports coming in. So again, in your risk management policy, it just draws that out. It says, yes, you rely on assurance reports coming in from people. And I would say that it's up to you to challenge those. If you're not happy with them, it's not presented how you want them, it's up to you to challenge those because, you're owning this. So there's a few nods like that which have come in, very subtle little things that just say this is what your tools in your toolbox for your risk management. So I guess that's if anyone's got any questions, but it's a tidy up of your risk management policy. It aligns to TCFD. And as I said, it does align also with the Isle of Wight Council Risk Management Framework, and that is the basis with which we'll be using to then be reviewing the risk register as a team So as I say, risk should be owned by all of us. It's going to be owned by you as well. It owns by you as well. So it's making sure we've all got a very clear understanding of what these risks are. And we in each, so Matt will have to look at admin, Joe's looking at accounting side, I'm looking at the governance, all looking at our different areas and framing them and working with different experts, whether it's IT and cyber, whatever it is, to put these risks on the register. And then for you to challenge back and say, well, what is the outcome? Are we happy with that outcome? Now we're happy with the mitigations. And then go back to risk appetite that Chris was saying, and then we have that healthy debate and conversation. So any questions? Any comments on the risk management policy?
Right, thank you, Louisa. Very good. Any questions to Louisa? I've been through this with the board anyway.
I was just going to say, are you happy with it?
Am I happy? Yes, I'm happy with it.
Yes.
All right,
That's
and I'll formally move the recommendations from the chair and look for a seconder. All right, Karen's seconding. All those in favour? It's unanimous. Thank you very much indeed.
Thank you. I should say that Hyman's have also looked at it, so I'm just in the next assurance piece there, because obviously TCFD's come in, so I just didn't want to miss anything. So thank you for that. Lovely. Yeah, number 12, risk register.
Yep.
I think Chris has said it all already. So hopefully you're starting to see different elements. So the ones that you had as red, we are looking at those. Those have been our focus areas to start with. We didn't want to ignore those. Cyber we brought to the board meeting. I guess it's a big ask. If there are any areas that you'd like to see, please let us know, and we will do our best to put them into the agendas. And again, if it's too high level or it's too much detail, please let us know. So as I say, on the risk register, we are doing a review as a team. The backbone for this is the risk management policy, which I just described, and we will be bringing it to the board in October, and then we'll be bringing it to you in November. And it's for you to look at, decide whether you're happy, you're comfortable with it. You're very happy with the challenge. And the main thing is to get comfortable with the different areas.
Right, thank you. Any questions for Louisa on this issue? No? Carrying on.
Yeah, okay. I was going to say, yeah. So moving on to legislation and regulation. Okay, so next. So I should say the board received quite a detailed Word document that sets out all the movement that's happening in a lot of legislation. So what TCFD was mentioned, for example, that's not going anywhere at the moment. We'll have to wait to see what the Labour government do, but it's not a requirement at the moment, but it's on there. We've got the cloud project on there. We've got other elements. If you'd like to see that, we can obviously put that into your pack so you can get visibility of it as well. But the board do go through that and they do look at that and monitor that. So that's just by the side. Big one today, which I think is in your pack, and the meeting paper is on TCFD because obviously the new requirements came in March. So I'm just going to try and share my screen quickly. See if I can move this out. Make it bigger. I've only got one slide. Oh, sorry, it's just jumped through. So it's just to say there is a lot in there. So to take it back to what every year you do a compliance statement and you sign off a compliance statement. It goes to the board, they have a look at it, and then it comes to you. Last year, I think you had areas that were flagged as areas where you were non-compliant, and you had an action tracker, and you were following and monitoring that and the progress of the board were, and bringing that up to you to see. So TCFD have obviously done a change. They've restructured, consolidated, but added in a few new areas as well around what they're looking for from a regulatory perspective. So what we're doing at the moment is, or what I'm doing at the moment is going through, there are 14 different areas which are outlined there. So the proposal is that I take them to the board first, who go through and they go through in detail, and then they bring any recommendations up to you. So as Martin said, the board looked at cyber. They did also look at risk management. So we went into a bit more detail on risk management in the meeting, not just the risk management policy and obviously risk register, but generally they had a set of slides that told them what we have in place at the moment around the framework and the different tools that they've got and the audits going on, etc. So we've covered 2. We've got a few more to go, as you can see, but actually they do bundle up quite nicely. So actually there's about 4 items that will be administration, which is Matt's area. But actually a lot of that, the good thing is you reported on a lot of that previously, it's contributions. And in fact, we've got an administration strategy, etc. Then there's the governance side. Again, I did that yesterday, which is quite good. So that's 5 of your topics, which will bundle up together and I'll present to the board next time. Actually, a lot of that is the fact you've got terms of reference in place, the fact that, you know, you've got all your constitutions, etc. So you're doing a lot of these things already. So I don't want to scare you. There is a lot of work involved because we have to go through as a team, each different tab. And then we have to present it to you in a manageable way. We've done 2, and then I'll be putting it into, there'll be 3 little packages going to the board next time. And then overall, there will be an overall report to tell you how we are how compliant you are as a fund against all of these different areas set out. And that will be coming to you then in November. And you'll be able to see whether we're compliant against regulation, whether it's best practice, or just a nice to have. And hopefully that will give you some assurance around, you know, the governance around the scheme. So, and alongside that, there will be an action tracker. So any areas where we think there are room for improvement, there'll be a proposal for an action tracker in areas. I'm hoping that we're making progress, and we've got quite a few things already in the pipeline around business continuity. We've got a nice cyber policy coming along. So hopefully there's some things, and you know, which have been bubbling along in the past that actually we'll be able to present to you, which will be ticking off some of the things that may end up on your action tracker anyway. We're making progress on those as well, so it's to give you some assurance. So that's the proposal. As I say, we're working our way through. The board did look at risk management and IT and cyber. They were happy with the scoring. There was no challenge back. They will be getting a report again in October to go back through to make sure they're happy. Assignments are also going to be looking through it to make sure that, you know, we're not just making it up, and we've got all the evidence in the background, which will give you another level of assurance. And hopefully then, as I say, that will give you a feel of where we are on the governance side of things.
Good.
Any questions?
Aren't we lucky to have Louisa on board?
Yeah.
Any questions?
Well, I've got a question. I don't know whether this is the time to put it. What's happening about the pensions dashboard? Do either of you? Yeah,
Yes, go for it.
yeah. I mean, it's the government there seems to be deathly silence.
I think it's still going ahead. It's I don't know what's going to happen with the current government, but it will definitely happen. So a lot of what we have got to do is look at our data and make sure our data's and then we've got to have a plan for when it comes into force. We're already talking to Haywoods about how we connect to it.
Right.
And they were one of the 7 companies that were involved with the government in setting it up.
Yeah.
So, you know, we're in a good position for it.
Yeah.
But again,
you know, because obviously it's sort of something there in the background. Will it create a lot of work?
yes,
I'm just thinking of staffing levels
I
again.
think the creation of work will be once we go live.
Yeah.
Because it's how people then interact with us
Right.
as a team. So the amount of queries, because it's obviously we've got to match data. So it's all right if everybody matches all the data, but if you're partially matched, then we've got to do some more due diligence and testing to make sure that they are the people they are.
Yeah.
So yes, it's going to be quite an experience for the team.
Any other
Talk about
questions?
staff resilience.
Karen and then Steve.
I'm being a bit silly, as I am. Dashboard.
It's a government-led initiative to make sure that everybody, all pension companies put their information and data on a system where people can go and have a look. Because obviously there's billions of pounds out there which is unclaimed pension money. People don't know that they're there. They've forgotten 20, 30 years ago they paid into a pension plan. So everybody will be able to go onto the dashboard and see what pensions they've got. Because everybody's got
I
to.
started one 30 years ago, but I didn't.
The
Whether
government,
it's private
the
or
government-
local governments, it's good for people.
the government will be able to know exactly what's going on and be
Yeah.
able to tax everything accordingly. Let's
They'll
talk
raise
about the
that.
real purpose.
It's more for people who move around, employers. So
Oh, I probably have got something there then.
in the workforce, if you're in a job for 2 years, you move into another one, it's very hard to keep track. The idea is you're meant to be able to go in because obviously we've got very agile work.
I have got something there then.
Yeah.
Yeah.
Steve,
I know it's not on the agenda, so I wouldn't expect an answer now, but in terms of the general sort of legislation and stuff that's happening nationally, do we know or can we find out where we are with the McLeod review? How that's going to affect local people?
We must that again.
We're working on it at the moment, Steve. So That's something that Hyman's going to be supporting with us, and that's part of what we're taking back a lot of the stuff from Hyman's with a view for them to supporting us, and also our new recruit into the data quality is also now starting to look at that. I have actually got a meeting with Haywards on Friday to look at where we are, because we've uploaded the data into test, a few bits that we've got to amend, and then we can upload the data into live, and then we'll be able to inform people if there's an impact on it. And it's due for next year's annual benefit statement. It should have the confirmation of where you were and where you are, the choice. Okay, so yes.
Right, thank you. So with that, I'll move the two recommendations we've got on here. Does anybody second that? Vanessa, everybody in favour of those two items? Karen?
Oh, sorry.
Thank you. Unanimous. Thank you very much. Thank you for the additional points, Matt. Right, updates on the knowledge and understanding update. Do we have any updates?
But just to say, so a couple of board members and third conference, so Bob was on the line, so both attended. We heard about the latest legislation around annual report requirements and TCFD, was obviously, and all the work packages going through SARB at the moment. I mean, Barbara, I don't know, am I allowed to ask Barbara if there's anything else that jumped out at you? No, I'm sorry to be on the spot there, but so I mean, the fantastic thing was it was noted that we had such great representation there from all the pension funds. There was only a small number of people in the room, and we had 3 people there. So that's credit to Tonya and Barbara for attending.
Yeah.
So you know, it's my job too. Yeah. So and then obviously, well, thank you, Councillor Churchman. If I can catch up with you next week or during the week around the meeting you went to last week. But again, all these things I need to just record on our database. At the moment, it's an Excel spreadsheet. So what's happening in the background? I have spoken to Wight Council around their training platform. And it would be really nice to put this into their portal, so we've got a really nice audit trail. So it's not just a spreadsheet with me inputting it in. So it would be nice. I have already started those conversations of speaking to the team a couple of weeks ago. So I will be picking that up again with them, because it's all about an audit trail, as you know, from the regulator's perspective. But I guess, sorry, going back to the first point, which is I just want to assure you that actually I'd say that you're doing a fantastic job. I mean, all the meetings you go to from an investment perspective and all the information you bring back to the meeting is fantastic. And again, on the board side, you know, keeping up with the regulations, you have great people really engaged. So, you know, you should take heart from that you've got a really good engagement as a group. Next step for me is to talk to you. I think what I'd like to do, so I've spoken to the board, and the board have said they'd quite like to do a face-to-face meeting, a one-day meeting, set time aside, where we just go back through and maybe involve the likes of Hyman's or something, and we just go back through and make things quite relevant to what's happening in the pension fund at the moment around some basic training, rather than having to do the online courses and everyone having to sit there in the evenings and plug through. And maybe that's something that you'd like to come along to. But as I say, that's what the board's preference is. I'd like to speak to all of you individually, actually, because I know there's a lot of time pressure for councillors. You have to do a lot of different things. I'd like to understand what the topics are that are of interest, and actually whether it's you'd like to come along to this meeting, or whether something else works for you better. And also for myself, understanding where you've got to with different things and your knowledge. And if, you know, because I know we had Hyman's do their assessment, and you know, there was scoring, and it said that everyone would like to know a bit more about admin, for example. You know, that's an area that's come through, so we've noted that. But actually, I'd just like to take time, so if I can maybe get 15, 20 minutes in the diary with each of you, just have a quick informal conversation about, you know, areas of interest, how you think things are going around training and knowledge coming into the meetings, and how we can structure some of that, if that's all right with you, rather than trying to get everyone together on a call and discuss it. Would that work with everybody?
Great.
Thank you. All right, item 15 on the agenda then is members' question time. We'll go round. Karen. No. Vanessa. No, there are no members' questions. Good. Right, exclusion of the press. This is what we're have to ask all the public the press to leave. Let's do some bits on the line. Already on to. I have to read out to consider passing a resolution that Under section 100A4 of the Local Government Act 1972, the press and public be excluded from the meeting for the following item of business, namely agenda item 17, on the grounds that there is likely to be a disclosure of exempt information defined in paragraph 3 of part 1 of schedule 12A of the Act, and in all the circumstances of the case, the public interest in maintaining the exemption outweighs the public interest in disclosing the information. So I formally move that. Look for a seconder. Karen, thank you. Everybody in favour of the exclusion? There you go. Carries unanimously. Thank you very much.
Me then, I feel better now.
We will have days like today.